Okay, in this tutorial, I'll be teaching you about ANSS symbol. I'll just copy that and I'll paste that in Google and click stock besides it. And that's the name. And if I want to buy it right now, I buy it for 209.7 US dollars. The market cap is in billions, which is a big size firm. And dividend yield is none. So a company that pays dividend, that means that they have extra money left and they can pay off to their shareholders. And this company don't have any dividend. It could be they're not generating extra money, or it could be that they are generating extra money but they are investing in their firm for growth. So it's up to them. And you want to see when was this founded, just go to Wikipedia, just find the box here and you just go to founded and click 1970. You can just see 1970. And I will just tell you one more thing, and I'll just copy that and I will paste it here and write review besides it and paste it in Indeed. And there are 73 reviews, and it's 3.8 star, which is brilliant. And I will just go to Glassdoor as well, and I will click here. And there are 332 reviews and it's 4 star, which is brilliant. So it tells a lot about the firm, how the employees feel like. Go to Yahoo Finance and I will click in search bar, and I can just find there, and I'll go to profile, and the sector is technology, industry is software application. You can see full-time employees. You can see the executives, only one executive salary is not shown, so you need to find why it's not shown, maybe look up to another website and stuff like that. And you need to be, the more information we have, the more better it is. Just go to Justia patents and I want to show you if it has any patents or not. And in 2015 it has a patent, 2016 it has a patent, right? So I'm looking at assignee or applicant. I'm not looking at inventors, because inventors are people who invented but they don't have full rights of the patents. Assignee or applicants have full right. So look at only assignee or applicant. So it's 2016 they have a patent, 2015 they have a patent, 14, 15, 1997, 2017. So they have 2016 recent patents, which is brilliant, because make sure they have recent patents so that they are still innovating, they're still competitive in their industry. And the more patents they have, the more better, the more stronger a firm is against their competitors. And so you just go through yourself, and I'll go to macro trend right now, and I will show you some ratios that are very important when analyzing a firm. And I will paste in the symbol here, and click to price ratio and price book ratio. And this website takes a little bit time to load because there's a lot of data, but this website is really important, for ratios. It calculates the ratio itself. You don't have to worry about formulas or be good in maths or whatever, so there's less headache. And I've left the link, but if you have any trouble with it, or if you need to ask any questions, or maybe I'm just going through the video very fast, you can just tell me and I'll slow down, and you can just ask as many questions as you want. So that's great. So it's just taking time to load. So once it's loaded, I'll try to explain. Book value is the real worth of share, and stock price is the market price. If book value is $1, stock price is $2, that means you're paying $2 to buy something that is $1 worth. You're buying something expensive. Price to book ratio, if it's less than 1, that means the stock is at discount or it is undervalued. You can buy it at bargain. It's cheap to buy if it's less than 1, and it's ideal to buy that time. If it's 1, that means that you're paying the exact same price. So it's ideal to buy because you're not buying it expensive. If it's more than one, that means you're buying it expensive. It's very expensive to buy. And the higher the number goes, the more expensive it gets. So let's see what we have right now. We have 6.55 ratio. It means that somebody who buys right now will be paying 6.5 times more money to buy this. It's very expensive. Somebody who buys in 2009 will be paying 1.89 times more money. If I just go up, look vertically up, I can see that people who bought in 2009 March, they paid $25 to buy something that was $13 worth. So they paid more price. They paid 1.89 times more price in 2009 March. But if somebody buys right now, they'll be paying 6 times, 6.5 times more money to buy that same stock. So if somebody bought in 2018, they would be paying 6 times more money to buy that stock. So if I just see vertically up, I can see somebody who bought in 2018 September bought it for $186 to buy something that was $30 worth. So they paid quite a lot of money, 6 times more money. That was very expensive. And right now, it's even more expensive. It's 6.5 times more expensive. So you need to be careful about that. But the most expensive it was in 2006 when it was 7 times more expensive. When somebody paid $27 to buy something that was only $3.78 worth. So you need to be careful about that. That maybe you're buying it very expensive. Maybe the stock is very good, but it's very expensive. So you need to, maybe you can wait about it to come down or what. Go to other ratios and let's look at current ratio right now. And if the current ratio is less than 1, it's a risky stock. It's very risky to buy. If it's 1.5 or more than that, that means it's a very safe stock. It has good margin of safety. It's ideal to buy. So it should be 1.5 or more than that. Right now it's more than 1.5. It's brilliant. Let's look at the previous trends. So I'm interested if it has ever been below 1.5. So mm, I can see that from 2009 June up till now, it has always been above 1.5 or 1.5, which is brilliant. So since I would say 10 years now, since 2009 up till now, 10 years, it has consistently been 1.5 or above than that. It has been consistently a safe and secure and a good margin of safety stock, which is a brilliant 10 years period is a lot. So it's brilliant. So let's look at debt equity ratio. This ratio tells me if the company is mainly operating on debt or equity. I'm looking for zero point 0.5 or less than that. Let's have a look. So I'm looking for zero point 0.5 less than that. Right now it's less than zero point 0.5. Previously, let's see previously. Since we have the data, it's consistently, yes. So we have data since 2006, 2005. From 2005 up till now, so it's like 14 years maybe, it has always been less than zero point 0.5 consistently, which means this stock has always been safe according to debt equity ratio. It has been safe and brilliant. So let's look at return on equity. We are looking for ratio 8% or more than that, ideally. So it takes time to load, so you need to be careful. So I'm looking at 8% or more than that. It is more than 8%, and previously as well, consistently more than 8%. Yes, so since 2007 up till now, it's like 12 years. Consistently, it has been more than 8%. So it is brilliant stock.